Welcome to our exploration of the Hammer Candlestick Pattern. Candlestick charts provide a visual language for deciphering market sentiment. Each candle tells a story of the battle between bulls and bears. Among these patterns, the hammer stands out as a beacon of hope for traders seeking bullish reversals. This pattern emerges after a period of downward price action. It signals a potential shift in momentum, offering a glimmer of opportunity amidst bearish dominance. The Hammer Candlestick Pattern is a powerful tool for technical analysis. It helps traders identify potential turning points in the market. Understanding the mechanics and psychology behind the hammer can be instrumental in making informed trading decisions. This knowledge empowers traders to capitalize on potential bullish reversals. The hammer pattern is particularly significant in the realm of candlestick charting. It represents a pause in the downward momentum of a stock or other financial instrument. This pause often precedes a potential upward price movement. Traders look for hammer patterns to identify potential buying opportunities. The study of candlestick patterns, like the hammer, provides valuable insights into market dynamics. By recognizing and interpreting these patterns, traders can gain an edge in understanding price action and predicting future market movements. The hammer is not just a pattern, it's a telltale sign of a potential shift in power from bears to bulls. Let's delve into the anatomy of a hammer visual identification. The hammer candlestick pattern is easily recognizable on a price chart. Its unique structure sets it apart from other patterns. Visually, the hammer has a small body, a long lower shadow, and little to no upper shadow. The small body indicates a period of indecision after a price decline. It shows that neither buyers nor sellers could establish a clear advantage during that period. However, the long lower shadow reveals a different story. This long wick suggests that sellers pushed the price down during the trading session, but buyers emerged with strength. They drove the price back up, closing near the opening price. The color of the hammer body can be either green, bullish, or red, bearish, although a green body is generally considered more bullish. A green body implies that the closing price was higher than the opening price, indicating buying pressure. Conversely, a red body suggests the opposite. The absence or very small size of the upper shadow is another important characteristic of the hammer. It indicates that the price did not move significantly above the opening price after the initial selling pressure subsided. This characteristic further emphasizes the strength of the buyers who managed to push the price back up. Now let's explore the psychology behind the hammer. The hammer candlestick pattern reveals a fascinating psychological battle between buyers and sellers. It's a story of initial fear turning into potential hope. Understanding this psychological shift is key to interpreting the hammer's significance. Imagine a stock in decline. Fearful sellers dominate, pushing the price lower. Suddenly, strong buying emerges, driving the price back up near its opening. This sudden surge in buying creates the hammer's long lower shadow. It signals that a support level might have been established. The hammer suggests that sellers may be losing their grip on the market. Buyers are stepping in, potentially seeing value at these lower prices. This shift in sentiment from fear to cautious optimism is the essence of the hammer pattern. The longer the lower shadow, the stronger the buying pressure is perceived to be. It shows that buyers aggressively rejected lower prices, creating a potential price floor. While not a guarantee of a reversal, the hammer's psychology suggests a possible shift in the balance of power.